Hello and welcome to this edition of Mic'd Up with ICM. I'm Pete Seyler, a member of the business development team here at Integrated Capital Management. And I'm excited to be joined today by Catherine Legraw, partner at GMO. Catherine, thanks for being here.
Oh, thanks for including me.
Absolutely. So ultimately, we've arranged this time today to jump in a few really quick questions that are important to our advisor base. Can we start by talking about the recent dynamics between growth and value? Obviously, leading up to 2021, it's a pretty difficult time to be a value investor, but that's changed meaningfully over the last year or so. Can you talk about that a little bit?
Absolutely. And I have an exhibit as well. It has been a long ride for value investors. This chart, which I'll refer to, shows the valuation of U.S. value stocks relative to growth stocks through time. And it's normalized such that one is fair value. So if the blue line is above one, we think value is expensive. And if the blue line is below one, we think value is cheap. And for quite a long time in the mid 2000s period, value was looking rather expensive. And then there was a long run of value underperformance, and it's become quite cheap. Value was looking cheap for a while, but then it got a lot cheaper in 2020. In fact, in the 12 months ending September 2020, value stocks underperformed growth stocks by 38% globally. That is the worst value underperformance ever by a wide margin. Also in 2020, we saw market dynamics really change. Until then, we had been on almost a hated bull market. There was no euphoria, there was no speculation, and then investor behavior turned really bubbly. We saw investors with retail stimulus to spend. We saw crazy trading in options. There was a lot of stock issuance. We had secondaries, IPOs, and then we had the SPACs, and a lot of stock price movements that seemed just divorced from their underlying fundamentals. And this in 2020 was before the meme phenomenon started. That was 2021. So when we got to October 2020, two things had happened. One is we'd seen massive value underperformance, and on our metric here, value got quite cheap. It was trading at close to 50% of fair value. It had only ever been cheaper at the height of the tech bubble. And coupled with that, we saw a really speculative investor market. So at that point, we thought value versus growth was such a big pitch that we launched a long value, short growth, absolute return strategy. Now, since then, things have turned around. Since October 2020, values beat growth by about 30% globally.
Yeah, that's a great point. And with value, US value outperforming growth by such a wide margin so far, even year to date, where does GMO see us in the current value growth cycle? And is this a trend that you think can continue?
We definitely think value has more to give investors. So today, which is also labeled on my chart, November 2022, value's trading at about a 23% discount to fair value. So still very cheap, 13th percentile relative to history. For value to go back to that normal historical median valuation, value needs to beat growth by another 30% in the US
Wow.
and about 20 to 60% globally. So if you ask me to pinpoint it, I'd say we're about midway through the value cycle. And in the
Wow.
US, oh, sorry.
No, absolutely. That's great information.
In the US, I was going to go into more detail
Please do.
about
Absolutely. This is great.
value cheapness. This chart also US, but here we've split the US market instead of two halves, value and growth. Here we've split it into five 20% cohorts. So the bottom line on this chart is the cheapest 20% of the market. That's in red. The top line of the chart is the most expensive 20% of the market. We've got each five equal cohorts. In value, which is the bottom half of this chart, we noticed a really interesting dislocation within the US. Deep value, even after a great run for value, is still very cheap. It is 7th percentile relative to its own history after a massive value outperformance. And this is a bit of a dislocation. Shallow value, the next cheapest 20%, is actually expensive. Anything over 50th percentile is expensive relative to its own history, and shallow value is 83rd percentile. So within the US, I would further say you can get a really interesting investment by focusing on the very cheapest cohort, what I would call deep value. And we've been tilting our clients' portfolios in that direction.
Wow. Tremendous information. And does your positive outlook on U.S. value also hold true for non-U.S. And emerging markets as well? Where do you see valuations in those asset classes today? More specifically, and we're big followers of your 7-year forecasts. What are the key contributors to your outsized return expectations for EM value?
Absolutely. We love value everywhere. That's the great thing about the value opportunity today. It's not just a US phenomenon, it is a complete global phenomenon, and value is cheap absolutely everywhere we look. Taking this same chart where we split the equity universe into 5 equal cohorts, we show that for non US markets. So on the left, we've got the developed markets outside the US, the MSCI EFA universe, Europe, Asia, and Far East. And on the right, we've got the MSCI emerging markets universe, so developed and emerging markets universe. And in both the developed and the emerging markets outside the US, we find value cheap, trading below its normal historic valuations, and we find growth expensive everywhere. I would give a little caveat that deep value is not a particular theme outside the US. Both deep and shallow value are cheap outside the US. So we advise investing in a broad value investment outside the US. You don't have to really dial into any particular cohort, but it is beautifully cheap. And I thank you so much for following the GMO 7-year asset class forecasts. The most important thing to know about our forecasts is they are anchored in valuation. So if you're comparing our capital market assumptions to any other capital market assumptions you see, probably a difference for GMO is that they're so informed by valuation. So today we have a beautiful expected return forecast for emerging markets value stocks, as you point out. We forecast expected returns above and beyond inflation. These are real return forecasts. What do we expect the market to deliver? And the components that we forecast are the fundamentals of the market. Any additional repricing from valuation, is the asset cheap or expensive? Then, as you noticed, a value universe, we say, is there any difference for investing in value in this market? And then finally, you could add currency. It's not in our published forecast, but I'll give you a little information on currency as well. So for emerging markets, we think the fundamentals look normal, if you will. We're expecting 6% real return from growth and from income from these stocks. And that's about normal for what we would expect for an equity in general. So 6% for the emerging markets just from their normal growth and income. Emerging markets overall look to be about fair value. So we're not expecting any positive or negative repricing to the market overall. But value within emerging markets, as we just point out here on this chart, is quite cheap. So we're expecting an additional return from that value premium, and that's 4 to 5%. So you've got 6% from fundamentals, add to 4 to 5% additional return from the value spread. And then finally, emerging market currencies are cheap too. So you could add an additional percent or so from expected appreciation for emerging market currencies relative to the US dollar. You add that all up and you get 10 to 12% real forecasted return for emerging markets value stocks, which means that even though there are definitely risks in this universe, they are risks you are being paid as an investor to underwrite.
Understood. Great information, Catherine. Again, I can't thank you enough for joining us today. Certainly valuable information that we look forward to sharing with our audience here at ICM. Again, big thank you to Catherine Legraw, partner at GMO. Again, I'm Pete Seyler, business development member here at ICM. Thank you for joining us for this episode. Any additional questions, you can reach us at 888-426-4689 or info@icm-invest.com. Thanks and have a great day.